So what if I told you the secret to incredible investing returns wasn't just about crunching numbers on a spreadsheet, but about becoming a detective?
Welcome back to Ben's Book Club. Today we are diving into a true classic, Common Stocks and Uncommon Profits. Now this book was written all the way back in 1958 by the legend himself, Philip Fisher. And honestly, a lot of people consider it the Bible of growth investing.
So, Fisher gets right to the heart of the problem, right? It's the question every single one of us faces as investors. You look at the market, you see thousands and thousands of companies. How on earth do you find that tiny handful that's going to deliver those incredible, life-changing returns over decades? It feels impossible.
Well, Fisher's answer was pretty radical for his time. He said, stop acting like a number cruncher and start thinking like a detective. He was totally convinced that the most important clues about a company's future, well, they aren't buried in a balance sheet. They're out there in the real world waiting to be found.
And this slide, man, this really frames the debate perfectly. Back then, Benjamin Graham, who we'll call the accountant, was the king of investing. His whole strategy was about finding so-so businesses at ridiculously cheap bargain basement prices. But Fisher, the detective, he just flipped that whole idea on its head. He said, no, it's way better to buy an outstanding business at a fair price because real long-term wealth comes from quality and growth.
And hey, if you need any proof that Fisher was onto something, just look at this quote. Warren Buffett himself said that Graham gave him the foundation, but that crucial 15% from Fisher, that's what taught him to hunt for truly great companies. I mean, that's not just a compliment. That's like a rock legend saying you taught them their best guitar solo. It's huge.
So if you're a detective, how do you actually gather all these clues? Well, Fisher had this secret weapon, a technique so powerful and, so original that it's still the gold standard for doing deep research today. He called it the scuttlebutt method.
Yeah, scuttlebutt. It's kind of a funny word, right? It actually comes from an old naval term for the gossip that sailors would trade around the ship's water cooler, the scuttlebutt. For Fisher, it meant getting the real story, the off-the-books intelligence, by going out and systematically talking to everybody and anybody connected to a company. It's all about piecing together a mosaic of insights you'd never ever find in an annual report.
So this is the playbook. This is how you build that intelligence network. You actually go talk to a company's competitors. You ask them, hey, what does your rival do better than you? You find customers and ask, do you really love this product or is it just okay? You track down former employees to get the real scoop on the company culture. See, each person gives you one little piece of the puzzle, and when you put it all together, a surprisingly clear picture starts to take shape.
Okay, so once you've done all your scuttlebutt, you've gathered your intel, you need a way to organize it all, right? That's where Fisher's famous 15-point checklist comes in. You can think of this as the detective's official case file for evaluating any company you're investigating.
The first few points are all about the future. See, Fisher didn't really care what a company earned last quarter. He wanted to know if it had a massive runway for growth ahead of it. Is its market big enough to keep expanding for years, even decades? And is its R&D actually creating killer products that people want, or is it just some expensive science project? Getting these answers helps you find a business that can grow your money for a very, very long time.
Next, our detective turns the investigation inward to the company's engine room. Are the employees happy? Are they productive? Because, great companies get that their people are their biggest asset. Is there a solid bench of managers ready to step up? Or would the whole thing fall apart if one key person leaves? These questions tell you if you're looking at a well-oiled machine that's built to last, or just a flash in the pan.
And finally, we get to the intangibles. And for Fisher, this was everything. This was the most important part. Is the management team playing the long game, or are they just obsessed with hitting next quarter's numbers? Are they honest and upfront, especially when things go wrong? And the big one, do they have unquestionable integrity? For Fisher, if the answer to that last question was no, it was an immediate deal breaker. Done. Everything else could be perfect, but without integrity, he was out.
So after all this intense work to find a truly exceptional company, Fisher drops one of his most powerful and honestly most radical ideas. It's about what to do after you buy. And let me tell you, his advice goes against just about every instinct a typical investor has. This quote, this is the very soul of his philosophy. Just let that sink in for a second. Almost never. The whole point of all this detective work isn't to find a stock you can flip in 6 months. The goal is to find a business you can partner with for a lifetime as it compounds and grows.
And he was incredibly strict about this. He said there are only three valid reasons to ever sell a great stock. 1, you realize you messed up your original investigation. 2, the business itself has genuinely, fundamentally gotten worse.
Or a 3, and this one is very rare, you find another opportunity that is just overwhelmingly, demonstrably better. That's it.
And you know what was absolutely not a good reason to sell? Cashing in just because the stock price has shot up. He was crystal clear on this. Selling a great, growing company for that reason is one of the biggest, most costly mistakes an investor can make. It's like jumping off a rocket ship right after it clears the launch pad. You miss the whole ride to the moon.
So why are we still talking about a book from 1958? I mean, really. It's because these core ideas, focusing on business quality, on management integrity, on true long-term thinking, are probably more important today than they've ever been.
And it all comes back to this number, doesn't it? That 15% from Fisher is the secret sauce that took Buffett from being a really good investor to, well, the greatest investor of all time. It's what taught him that famous lesson. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
So what's in your detective's toolkit from all this? Number 1, focus on the business, not just the stock price. Number 2, do your own homework, your own scuttlebutt, to get an information edge nobody else has. 3, completely reframe how you think about selling. Don't ask, is the price up? Ask, has the business fundamentally changed? And finally, concentrate. Put your money into your very best ideas.
And that leaves us with one last big question to chew on. In today's world of algorithms, high-speed trading, and just constant information overload, is it possible that this old-school, patient, deeply human way of investigating a business is actually the most valuable edge you can have? Something to think about.
And that's our look at the Philip Fisher playbook. I hope you got a ton out of it. Make sure you're subscribed so you don't miss an episode.